In August of 1929, a small group of bankers met in a private dining room at the Federal Reserve Bank of New York. The meeting wasn't on any official calendar. No minutes were recorded. No press was notified. But the documents from that gathering, recently uncovered in a dusty archive, reveal something that will change how you understand what happened next. And more importantly, what's happening right now. The men in that room weren't discussing interest rates or monetary policy. They were discussing timing. How long could they maintain the illusion? When should they begin the final phase? And most chilling of all, they had a checklist. 7 specific conditions that needed to be met before they could proceed with what one attendee called the Grand Correction. By October 1929, every single condition on that checklist had been satisfied. What I'm about to show you isn't speculation. These are actual documents, memos, private correspondence, meeting notes that were supposed to remain sealed forever. And they prove that 1929 wasn't a crash. It was a controlled demolition. But here's what should terrify you about these revelations. The same checklist, the same 7 conditions, the same language, the same methods are being used today. Not similar, identical. We're not heading toward another 1929. We're completing the original plan that was interrupted by World War II. And the evidence is hiding in plain sight if you know where to look. Before we dive into what these documents reveal, you need to understand how financial power actually works. Not the version they teach in economics textbooks, but the real mechanism that has controlled global wealth for over a century. Because without understanding the architecture, you'll never see how the blueprint is being followed today. In 1913, something unprecedented happened in American finance. The Federal Reserve Act wasn't just legislation. It was the culmination of a 20-year strategy that began on Jekyll Island in 1910. But what most people don't know is that Jekyll Island wasn't the first meeting. It was the final planning session for a system that had been designed decades earlier in London. The Bank of England had perfected a model that allowed a small group of private institutions to control an entire nation's monetary supply. They discovered something revolutionary. You don't need to own the government to control it. You just need to control its ability to borrow money. And once you control borrowing, you control everything else. Spending, taxation, military operations, social programs, even elections become dependent on your approval. The American version was more sophisticated. Instead of one central bank, they created a network of 12 regional banks that appeared decentralized, but were actually controlled by a handful of New York institutions. The Federal Reserve Bank of New York, which held the real power, was owned by the same banks it was supposed to regulate. It was brilliant. They had created a private monopoly with government backing and public legitimacy. By 1920, this system was operational but not yet tested. The real test would come during a crisis when public attention was focused elsewhere and dramatic action could be justified as necessary intervention. That test was being carefully planned throughout the 1920s. The documents I mentioned show that by 1927, the planning had moved from theoretical to operational. Internal memos between the Federal Reserve Bank of New York and its primary member institutions reveal something extraordinary. They weren't trying to prevent a financial crisis. They were engineering one. The language is careful, coded, but unmistakable once you understand the context. References to market correction mechanisms and liquidity adjustment protocols that sound like boring technical discussions. But when you read them alongside private correspondence between bank executives, the real meaning becomes clear. They were coordinating the largest transfer of wealth in American history. Here's how it worked. Throughout the 1920s, they systematically inflated asset prices through easy credit and margin lending. Anyone could buy stocks with just 10% down, borrowing the remaining 90% from banks. This wasn't accidental policy. Internal documents show it was deliberately designed to create maximum leverage throughout the entire financial system. But leverage is a two-edged sword. When prices rise, it amplifies gains. When prices fall, it amplifies losses. And if you control the credit that creates the leverage, you also control when the leverage destroys those who borrowed. The checklist I mentioned earlier wasn't about economic indicators. It was about positioning. 7 specific conditions that would ensure maximum impact when they pulled the trigger. First, margin debt needed to reach unsustainable levels. By September 1929, margin debt was over $8 billion, more than the entire federal budget. Second, public participation needed to be at historic highs. By late 1929, everyone from shoeshine boys to university professors was speculating in stocks. Third, alternative investments needed to be eliminated. Throughout 1928 and early 1929, bond yields were systematically lowered, making stocks the only attractive investment for yield-seeking investors. Fourth, international coordination needed to be established. Documents show extensive communication between the Federal Reserve and the Bank of England throughout 1929, coordinating policy actions across both markets. Fifth, media narrative needed to be controlled. By mid-1929, financial newspapers were publishing almost daily articles about the new era of permanent prosperity and how traditional economic rules no longer applied. Sixth, political cover needed to be arranged. President Hoover, who took office in March 1929, had been briefed on potential market volatility and assured that Federal Reserve intervention would stabilize any disruptions. And seventh, the most crucial condition, insider positioning needed to be complete. This is where the documents become truly damning. Starting in early 1929, there was a systematic pattern of selling by bank executives, Federal Reserve board members, and their associates. Not panic selling, but methodical liquidation disguised as routine portfolio rebalancing. By August 1929, every condition was satisfied. The trap was set. All that remained was triggering the mechanism. On September 5th, 1929, economist Roger Babson gave a speech predicting a market crash. The speech wasn't spontaneous. Documents show Babson had been approached weeks earlier by intermediaries connected to Federal Reserve member banks. His job was to plant the first seed of doubt in an over-leveraged market primed for panic. The reaction was immediate but contained. Stocks dropped but recovered within days. This wasn't the trigger. It was a test. They needed to see how quickly panic could spread and how effectively it could be contained when necessary. The test results were apparently satisfactory because 2 weeks later, the Bank of England raised interest rates unexpectedly, citing concerns about gold outflows. This created immediate pressure on American markets because higher British rates made British bonds more attractive than American stocks. Capital began flowing from New York to London, creating the liquidity squeeze that would make leveraged positions impossible to maintain. But even this wasn't the final trigger. That came on October 23rd when a coordinated selling program began executing across multiple major institutions simultaneously. This wasn't random panic. Document analysis shows the selling followed predetermined schedules across different market sectors designed to create maximum psychological impact while maintaining plausible deniability. The beauty of the plan was its apparent randomness. To outside observers, it looked like natural market forces creating an inevitable correction, but the timing, the coordination, the specific targeting of the most leveraged sectors, all of it followed the blueprint that had been developed over the previous 2 years. Within hours, margin calls began cascading through the system. Investors who had borrowed 90% to buy stocks suddenly needed to provide more cash or face forced liquidation. But the banks that had eagerly provided margin loans just weeks earlier were now demanding immediate repayment. Credit that had been abundant became impossible to obtain. This is where the true genius of the plan becomes visible. The same institutions that had created the leverage were now positioned to benefit from its destruction. As over-leveraged investors were forced to sell at any price, these institutions were ready to buy quality assets at massive discounts. The liquidation wasn't chaotic, it was surgical. Bank records from November 1929 show that while ordinary investors were selling everything at devastating losses, a select group of institutions were making targeted purchases. Properties that had been worth millions were acquired for thousands. Entire companies were purchased for less than their cash reserves. Industrial equipment, real estate portfolios, even art collections were transferred at prices that represented 90% discounts from peak valuations. But the most revealing aspect of these documents isn't what they show about 1929. It's what they reveal about the system that emerged afterward. Because the crash wasn't the end of the plan. It was the beginning of a complete restructuring of American finance that would take decades to fully implement. Within months of the crash, new legislation was being drafted that would fundamentally alter how banking operated in America. The Glass-Steagall Act, the Securities Exchange Act, the creation of the FDIC, all of these reforms were presented as responses to the crisis. But internal correspondence shows the frameworks for these laws had been developed years before the crash occurred. They had engineered the problem and prepared the solution simultaneously. The same individuals who had coordinated the crash were now positioned as the experts qualified to fix the system they had broken. It was a masterpiece of controlled chaos, followed by organized reconstruction. The Federal Reserve, rather than being dissolved for its role in creating the crisis, was granted expanded powers to prevent future crashes. The banks that had manipulated the market were now given regulatory authority over their competitors, and the investment houses that had profited from the collapse were transformed into the architects of the new financial order. By 1935, the restructuring was complete. American finance had been centralized under a handful of institutions that controlled not just banking, but insurance, securities, and even industrial policy. What had taken decades to build in Britain had been accomplished in America within 6 years. The crash had provided the justification for changes that would have been impossible under normal circumstances. But here's where the story takes a turn that even the architects didn't anticipate. World War II erupted before they could implement the final phase of their plan. Suddenly, government spending exploded, employment surged, and the economic control they had established became secondary to wartime mobilization. The completion of their system was postponed indefinitely. For the next 70 years, they maintained their positions, refined their methods, and waited for the right moment to finish what they had started. And now, if you examine current financial conditions against that original checklist from 1929, something terrifying becomes clear. Every single condition is being replicated with mathematical precision. Modern margin debt doesn't exist in traditional forms, but algorithmic trading, derivatives, and leveraged ETFs have created exposure that dwarfs anything seen in 1929. Where 1929 had 10-to-1 leverage through margin accounts, today's system operates with leverage ratios of 50-to-1 or higher, hidden within complex financial instruments that most investors don't understand. Public participation has reached levels that exceed 1929 by orders of magnitude. Where the 1920s saw widespread stock speculation, today's markets include retail options trading, cryptocurrency speculation, and social media-driven investment frenzies that involve hundreds of millions of participants globally. The scale of public involvement in financial markets today makes 1929 look conservative. Alternative investments have been systematically eliminated through a decade of zero interest rate policies that made bonds worthless and real estate prohibitively expensive. Just as in 1929, stocks became the only investment offering any potential return, forcing pension funds, insurance companies, and individual savers into equity markets, regardless of valuation levels. International coordination today surpasses anything possible in 1929. Central banks across the globe now coordinate policy through regular meetings and shared databases. When the Federal Reserve adjusts rates, the European Central Bank, Bank of Japan, and other major institutions adjust theirs within hours. The level of synchronized control over global liquidity is unprecedented in human history. Media narrative control has evolved far beyond what was possible in the 1920s. Where 1929 required influencing a handful of financial newspapers, today's system shapes information through algorithms, social media platforms, and financial television networks that reach billions of people simultaneously. The message is identical to 1929, that technology has created a new era where traditional economic rules no longer apply. Political coverage has been arranged through decades of revolving door relationships between regulatory agencies and the institutions they regulate. Former Treasury secretaries become bank executives. Former Federal Reserve officials become hedge fund managers. Former bank executives become Treasury secretaries. The same individuals move between public and private roles, ensuring policy coordination that was impossible in 1929. And insider positioning, the seventh condition, has been executing systematically for the past 3 years. Corporate executives have been selling their own company's stock at record levels. Billionaires have been liquidating equity positions and moving into cash, gold, and real estate. Institutional investors have been quietly reducing exposure to the most vulnerable sectors while publicly maintaining optimistic forecasts. The checklist from 1929 hasn't just been replicated. It's been perfected using tools and techniques that the original architects could never have imagined. But the fundamental strategy remains identical: create maximum leverage, ensure widespread public participation, eliminate alternatives, coordinate internationally, control narrative, arrange political cover, and position insiders for profit. The difference is scale. Where 1929 affected primarily American markets, today's system is global. Where 1929 involved millions of investors, today involves billions. Where 1929 transferred wealth within one country, today's version will transfer wealth between entire nations and continents. Recent banking legislation has quietly removed many of the protections established after 1929. Glass-Steagall was repealed. Derivative markets were deregulated. Banks were allowed to grow larger than ever before while taking on risk levels that exceed anything seen in the 1920s. The safeguards built after the last controlled demolition have been systematically dismantled. And just as in 1929, the trigger mechanisms are now in place. International tensions that could justify emergency measures. Currency instabilities that could require immediate intervention. Debt levels that could necessitate radical restructuring. Energy disruptions that could provide cover for dramatic policy changes. The documents from 1929 show that timing was everything. Too early, and public resistance would be too strong. Too late, and alternative power centers might emerge. The moment had to be perfect, when maximum vulnerability coincided with minimum resistance and optimal positioning for those controlling the process. Today, every indicator suggests that moment has arrived. Central bank coordination has reached levels that would have amazed the 1929 architects. Digital surveillance capabilities allow real-time monitoring of public sentiment and market positioning. Emergency powers legislation provides legal frameworks for unprecedented intervention. And most importantly, public attention is focused on geopolitical conflicts, while the financial machinery operates in the shadows. But there's something in these documents that reveals an even darker truth. The 1929 operation wasn't just about wealth transfer. It was a test case for social engineering on a massive scale. Internal memos discussed not just market manipulation, but behavioral conditioning, how populations react to financial stress, how quickly democratic institutions can be bypassed during crisis, how effectively emergency measures can become permanent policy. One particularly chilling document from December 1929 discusses Phase 2 implementation. While the public was still reeling from the market collapse, private meetings were already planning the next stage. The crash had demonstrated that entire populations could be psychologically conditioned to accept radical changes they would normally resist. Economic trauma created compliance. Financial uncertainty generated demand for authority. The language is clinical, discussing human behavior like laboratory data. References to stress response optimization and compliance acceleration protocols. They weren't just stealing money. They were studying how to break and reshape entire societies through controlled economic collapse. Phase 2 was supposed to begin in 1934, but the rise of populist movements across America forced a delay. Huey Long, in Louisiana, Father Coughlin's radio broadcasts, even early union organizing represented unexpected resistance to their consolidation efforts. The masses were proving harder to control than anticipated. World War II solved this problem by redirecting social energy toward external enemies instead of internal economic conditions, but it also prevented completion of the financial restructuring they had planned. Victory over fascism required genuine industrial mobilization that conflicted with their consolidation objectives. They had to choose between defeating external enemies and completing internal control. They chose victory, postponing their ultimate goals until conditions became favorable again. And for 70 years, they maintained their positions while gradually rebuilding the conditions necessary for final implementation. Every financial crisis since 1929 has been a smaller scale rehearsal. The savings and loan collapse of the 1980s, the dot-com crash of 2000, the housing crisis of 2008. Each event tested different aspects of crisis management and social control, but none of these were complete implementations of the 1929 blueprint. They were practice runs, allowing refinement of techniques while gradually conditioning populations to accept economic instability as normal. Each crisis normalized previously unthinkable levels of government intervention in private markets. Each bailout established precedents for wealth redistribution upward during emergencies. The 2008 crisis was particularly revealing because internal documents from that period mirror the language used in 1929. References to too big to fail and systemic risk provided justification for transferring private losses to public balance sheets. The same institutions that had created the mortgage bubble were designated as essential to recovery. Just as in 1929, the architects of the problem became the managers of the solution. But 2008 was still incomplete. Public anger remained too high. Alternative media was beginning to expose the mechanics of financial manipulation. International resistance was growing as other nations questioned dollar dominance. The timing wasn't perfect yet. Now, as we stand in 2025, that perfect timing has finally arrived. The same 7 conditions from 1929 are not just present, they're operating at unprecedented scale, with technological precision the original architects could never have imagined. The documents don't lie. The pattern is unmistakable. We're not approaching another crash. We're witnessing the completion of a century-long plan that was merely interrupted, never abandoned. The only question remaining is whether you'll recognize the signs before it's too late, or if you'll become part of the final phase they've been engineering since that secret meeting in August 1929.